I think everyone's trying to place a strong degree of emphasis on what the price action is going to be today, and there really is no relevancy to that. If you're going to look at the first trading date of the year and trying to extrapolate what that means for the remainder of the year, the return on that is less than 50%. So that's a coin flip at best. But back to your point, as it relates to the manufacturing figures, obviously it had an impact. You learned a little bit about oil today and the fact of we are dealing with supply concerns, not demand concerns, because oil was down on those weak manufacturing figures. However, they reversed on the news that Saudi exports was 7.25 million barrels per day. That's a 500,000 barrels less than expected in the month of December. So the Saudis are taking supply off the market. You saw the reversal in oil, and thus you're seeing a little bit of a bounce here in equities. But again, I don't want to make too much about the first trading day of the year.
All right. So, Josh, you got Fred Wilson, noted venture capitalist, calling 2019 a doozy. In his words, I think we'll see major dislocations in the leadership of the U.S., bear market in stocks, weakening economy, a number of issues with the global economy, a messy Brexit, sluggish China. That from Fred Wilson. That doesn't bode well if he's right for stocks.
Yeah, I like Fred. I have a lot of respect for him, and I think he's been really right on a lot of important stuff in technology over the years. But a lot of what he's doing is like taking all of the negative headlines and packaging them together. And I think you could do that any year. In fact, I've seen people do it any year. So I don't know if we want to worry about that. I think the big things to focus on in my book would be as follows. Number one, leverage loans and anything sub-investment grade credit. I think you want to watch the ETFs because we're not just talking about the underlying portfolios of these things deteriorating. We're talking about sentiment toward them. BKLN is an ETF that you can follow. That's leverage loans. It's basically non-bond debt, and you see it falling off a cliff in the last couple of weeks, and I think that's concerning. I think another thing that you want to look at, of course, the yield curve. We all are. Maybe that'll act as a governor and keep the Fed out of the game. But then the third thing I want you to think about is that we've already had a 20% correction from the September high. The average annual correction, intra-year correction, is something on the order of 14 or 15%. So we've already experienced that within the last 12 months twice, because we had one in February as well. So I don't know that we need to have a lot more damage. I think right now the best attitude would be, look, I'm not going to be a crazy bull, I'm not going to be a crazy bear. I'm going to allow some of these trends to develop, see if they stop, see if they get worse. And I think that's where a lot of investors are right now.
Doc, maybe negative sentiment's a contrary indicator in and of itself, right? If you look at the Wilson comments, you couple that with Rubini's op-ed last week talking about the president flirting with mutually assured economic destruction.
Right.
You have today, SocGen says we're only at the beginning. Those are their words. They're looking for another 50% decline in stocks. Now, in fairness, they've been pretty negative almost the whole way through the bull market. But still, sentiment couldn't get any more negative, I feel, than it is today.
It's certainly, based on those that you just cited, those were all very negative, Scott. As far as if I'm in a room full of horse dung and I'm looking for the pony in the room, I'd say that pony would be that China, last time they had a PMI contraction like this, they actually were negative. They went below 50. The last time we had that, they put $125 billion to work like that in this infrastructure project. I think the same sorts of things, if you read between the lines, are happening right now in China because they're scared. They're scared that things are slowing and stammering over in China. That doesn't mean that they'll take a bad trade deal. I'm not implying that. But I am saying that they will throw cash at this because they have it.
Lighthizer, though, Farmer Jim, is out today saying you may need more tariffs on Chinese goods. And I could tell you that, okay, if that happens, if you get this additional couple $100 billion,
I'm feeling good, Scott. Don't freak me out.
That amount of goods.
No,
Stocks
listen,
are not going to take that
listen,
well.
okay, so all chuckling aside, no, it's going to be a disaster if we get to February 28th, which is roughly the 90-day limit from the Buenos Aires meeting, and we don't have a deal in place and those tariffs go into effect. Before then, what I'm worried about along the same lines is we're going to get into earnings season here in a couple of weeks. What should we expect from that? We should expect that the fourth quarter reports are going to be great, but the guidance is going to be lousy. It's going to be murky at best and lousy, and it's going to hinge on China. So I'm expecting for the next 2 months for the markets to go up and down down depending on comments like Lighthizer or tweets like the one we got from Trump on Sunday night that was positive on the potential for a China
for the next few months. Is that what you think?
I think so. But I will say this, and I say this emphatically. If you get a China deal, a meaningful China deal, and you get profits anywhere near where they're expected on the S&P 500 for this year, boy, we're at about 14.5 times earnings. We will go higher, meaningfully higher.